The global economy right now feels like a high-stakes chess game. Only the board is on fire. The rules are changing mid-match, and the pieces are worth trillions of dollars. Over the past several weeks, we have watched a volatile mix of geopolitical brinkmanship, historic capital expenditure in artificial intelligence, and shifting central bank policies collide in ways that are testing both investor conviction and the limits of the current market rally. Let's begin in Washington, where trade policy has shifted from hard bargaining to outright economic confrontation. The United States has rolled out a fresh wave of tariffs that are as aggressive as they are unpredictable. India and Brazil now face duties of 50%, while imported semiconductors, unless sourced from companies pledging big American investments like Taiwan's TSMC, South Korea's Samsung Electronics, or SK Hynix, face a 100% tariff. These measures mark a decisive departure from the multilateral trade framework established after World War II under the GATT of 1947. And they have raised a critical legal question. Does President Trump even have the authority to impose such sweeping changes without congressional approval? The impact is being felt across continents. Japan thought it had secured a deal capping tariffs at 15% on most exports. But a stacking quirk now applies that 15% on top of existing levies, an unpleasant surprise for Tokyo that risks undermining trust. By contrast, Brussels appears to have negotiated a cleaner arrangement. But uncertainty still hangs over sectoral tariffs on cars, pharmaceuticals, and chips. And those uncertainties matter. Trump has already floated the idea of a 100% duty on semiconductors, with exemptions for companies actively reshoring production. India's position is especially delicate. The latest tariffs are retaliation for its continued imports of Russian oil. Now, Prime Minister Narendra Modi is preparing his first visit to China in 7 years, a diplomatic pivot that could signal deeper strategic realignment. The risk for Washington is clear, that its punitive trade measures push New Delhi closer to Beijing, redrawing alliances in ways that reverberate across global supply chains, energy flows, and regional security balances. Europe, meanwhile, has its own troubles. In Germany, factory orders and industrial output both fell sharply in June, erasing the temporary boost that came from pre-tariff stockpiling. The European Central Bank's latest bulletin warns that sectors with higher exposure to Chinese competition between 2019 and 2024 have already suffered sharper declines in labor demand. And if U.S. tariffs divert more trade into Europe, it could mean lower employment, weaker wage growth, and subdued inflation across the euro area. Across the Channel, the Bank of England has just cut its benchmark rate from 4.25% to 4%. But this was far from a unanimous decision. 4 of the 9 Monetary Policy Committee members wanted to hold steady. Inflation remains stubborn, with headline consumer prices up 3.6% year-on-year, core inflation at 3.7%, and services inflation stuck at 4.7%. Governor Andrew Bailey has signaled a cautious path of gradual easing, yet markets have scaled back the odds of another cut this year from near certainty to roughly 73%. In the United States, weak jobs data in July, only 73,000 new non-farm payrolls versus expectations of 105,000, combined with a 2-month downward revision of 258,000, the largest in more than 4 decades outside the pandemic, have tilted expectations toward looser monetary policy. Money markets now price in 61 basis points of cuts by year-end, nearly double what they anticipated before the jobs report. But the tariff landscape complicates the picture. Higher duties could lift inflation, forcing the Federal Reserve to weigh slowing growth against renewed price pressures. Adding to the intrigue at the Fed, Trump has nominated Stephen Moran, an outspoken supporter of tariffs, to temporarily fill the seat vacated by Governor Adriana Kugler. Moran argues tariffs are disinflationary and accuses Fed officials of tariff derangement syndrome. His presence would almost certainly bolster the dovish bloc. Meanwhile, speculation is mounting that former hawk-turned-dove Christopher Waller is the leading candidate to replace Jerome Powell when his term as chair expires next May. While geopolitics and monetary policy are stirring plenty of uncertainty, perhaps the single most powerful market driver today is the unprecedented wave of spending on artificial intelligence. The so-called hyperscalers, Microsoft, Amazon, Alphabet, and Meta, are engaged in an arms race to build the data centers, acquire the GPUs, and hire the talent they believe will secure dominance in the era of superintelligence. The numbers are staggering. Total capital expenditure by the major hyperscalers, plus Oracle, is set to hit $381 billion this year, up 145% from 2023. Meta alone plans to invest $100 billion next year, more than half its projected revenue, while its current year capex of between $66 and $72 billion is almost equal to its forecast profit of $71 billion. Apple, long seen as cautious in AI, has pledged $600 billion in U.S. investments over the next 4 years, including a fresh $100 billion announced alongside Trump at the White House. Valuations are soaring in response. The S&P 500's price-to-sales ratio is at a record 3.33, and the U.S. share of global market capitalization is back to 64.7%. NVIDIA, the undisputed hardware champion of this boom, has seen quarterly revenue explode from $6 billion to $44 billion since Microsoft's 2023 investment in OpenAI ignited the race. Although growth has slowed to 12% quarter-on-quarter from 88%, the concentration of demand is remarkable. Roughly 42% of NVIDIA's fiscal 2025 revenue comes from the hyperscalers and Tesla. Yet beneath the euphoria lie structural limits. AI researchers, including many from Generation Z, argue that large language models are advanced pattern matchers, not genuine reasoning engines, and that scaling them runs into diminishing returns, ever greater costs for ever smaller performance gains. Energy demand is another constraint. The International Energy Agency projects global data center power consumption will more than double to 946 terawatt-hours by 2030, with U.S. usage rising from 183 to 426 terawatt-hours. All this is playing out against a volatile geopolitical backdrop. Trump is preparing to meet both Vladimir Putin and Volodymyr Zelensky, following reports that Moscow might offer concessions to avoid further secondary sanctions. Anecdotal evidence suggests India's state-owned refiners have already stopped buying Russian oil, at least for now. In Europe, skepticism is high that any peace deal would be balanced, with fears that a Russia-friendly agreement could be framed as a Trump diplomatic victory while leaving Ukraine in a weaker position. The bottom line is that markets are balancing on a razor's edge. On one side, you have the AI-driven capital spending boom, inflating valuations and fueling optimism about transformative technologies. On another, you have trade policies that threaten to disrupt supply chains, raise costs, and reshape alliances. And on a third, you have central banks navigating the tightrope between supporting growth and containing inflation, all while political forces try to bend monetary policy to their will. History offers a cautionary tale. From the railroad booms of the 19th century to the dot-com frenzy of the late 1990s, financial markets have often rallied deep into a technological hype cycle, right up until the moment the economics failed to justify the valuations. The risk today is that any sudden shift, whether a hyperscaler pulls back on spending, tariffs escalate into a trade war, or a central bank miscalculates, could puncture confidence and trigger a rapid repricing. For now, the show goes on. The high wire act continues. The crowd is still cheering and the net below is looking dangerously thin. Investors, policymakers, and corporate leaders alike are playing for high stakes. And the moves they make in the next few months could set the tone for years to come.